Today, we're cracking open the financial rulebook that governs two of the world's biggest economies, the US-Japan Tax Treaty. Now, I know, it sounds a little dry, but trust me, this thing is the invisible architecture behind literally trillions of dollars in trade and investment.
So let me ask you something. Imagine you earned some money. The government comes along and takes its cut in taxes, right? But what if, right after that, another government showed up and decided to tax that exact same money all over again? Not a great deal, huh?
Well, for anyone doing business across borders, that's not just some weird hypothetical. It's a very real problem called double taxation. And without any rules, it would just completely freeze up international trade. It's a huge, costly barrier. I mean, just think about it for a second. Without a treaty, a US company earning money in Japan could get hit with the full Japanese tax bill, and then, when they bring that money home, get hit with the full US tax bill on the very same profits. Who would even bother? It kills the deal before it even starts.
And that is where our hero enters the scene, the tax treaty.
The official name is pretty long, but all you need to know is that it's an agreement designed to solve this one massive problem. It creates a clear set of rules so everyone's playing the same game. So what's its mission? Well, it's got four main jobs. Job number one, the big one, is to stop that double taxation. Job number two is to prevent tax evasion by making sure the two countries are sharing information. Third, it's all about making business easier, promoting cooperation. And finally, it provides certainty, a stable rulebook, so that businesses can plan for the future. But here's the thing. This rulebook isn't some dusty old document sitting on a shelf. The global economy changes fast. So just like the software on your phone, this treaty needs regular updates to keep up. The modern version really got its start back in 1971. But then, fast forward to 2003, the world is way more globalized, right? Money and ideas are flying across borders. So the treaty got a massive overhaul. They slashed tax rates to make doing business way more attractive. Then, in 2013, they fine-tuned it even more, bringing in things like mandatory arbitration, which is basically a guarantee for investors that any disagreements will get sorted out fairly. Okay, so we know why it exists and how it's evolved, but how does this whole thing actually, work? Let's get into the mechanics of how it stops that double tax problem in its tracks. It all boils down to this one fundamental question. Who gets the right to tax a specific piece of income? Is it the country where the money was made? Or is it the country where the person or company earning it lives? That's the puzzle the treaty has to solve. And to solve it, the treaty uses this really key concept called a permanent establishment, or just PE. The easiest way to think about it is as a physical business footprint. If a US company sets up an office, a factory, or even a long-term construction project in Japan, boom, that's a PE. And that's what generally gives Japan the first right to tax the profits made right there. So once we've decided that a country can tax something, the treaty's first move is to put some limits on that. It basically tells the source country, that's the place where the money was earned, okay, you can tax this, but only up to a certain point. It limits their tax bite. And you can really see this in action right here. Look at this. It's like a before and after picture. Back under the old treaty, if a Japanese company paid a US company for a patent or for software, that's a royalty, it was taxed at 10%. Now, zero. A big, fat zero. In today's tech-driven world, that is an absolute game changer. It lets ideas and technology flow so much more freely. Okay, so putting a cap on the source country's tax is huge, but that's only half the solution, because you still have to deal with your own government, right? Your home country also wants to tax your income from all over the world. So how do we fix that? And this is the other really brilliant piece of the puzzle. It's a two-part system. While the source country agrees to limit its tax, your home country, your country of residence, steps in to provide relief. In the US, this is done with something called the foreign tax credit. It's pretty simple, actually. Any income tax you pay to Japan directly reduces the US tax you owe on that same income. The two sides work together perfectly so you never get taxed twice. So those are the nuts and bolts. But let's zoom out. What does all this mean in the real world? This isn't just about tax codes. This framework has a massive effect on both economies. The impact is just enormous. It gives businesses the certainty they absolutely need to make huge long-term investments. By getting rid of taxes on things like royalties, it sparks innovation and technology sharing. And by having a fair process for solving disagreements, it gives everyone the confidence that they'll be treated fairly.
It really is the bedrock of the economic relationship.
And this quote just says it all, doesn't it? We're not talking about a small amount of money here. This is the framework that allows one of the most important economic partnerships on the planet to actually work day in and day out. So in the end, the US-Japan tax treaty is kind of like the foundation of a giant skyscraper. You never see it, you probably don't even think about it, but without that deep, carefully designed piece of financial architecture, the whole amazing structure of trade and investment built on top of it would be incredibly shaky.
It really makes you wonder, doesn't it? What other invisible rulebooks and agreements are out there, quietly shaping our world every single day? Thanks for digging into this with me.